What's good, traders? What's good, YouTube? I hope you're all feeling fine today. So on this video, we'll be talking about the differences between volatility and currency pairs. Now, as some of us wonder, how are they trading this volatility, and what are the benefits of trading volatility rather than trading the currency pairs? Okay, so currency pairs are basically having to trade one pair against the other. Like as we have here now, we have the GBP USD, we have the USD NGN, we have the USD cards, Euro USD, and others. So these are currency pairs. That's why I call them currency pairs. So trading them, first of all, trading currency pairs is trading with the news in mind. That is trading with the economic reports in mind, and the country's GDP and any other fundamental factors before you can trade them. But trading volatility, you don't need to trade having all these kind of factors in mind. So let's go to our volatility. So when you want to trade volatility, you have to know derivative. Now this derivative offers instruments to trade with, like the volatility, the derivative instrument. So if you want to trade from derivative, that is, if you want to trade volatility, you come to derivative here and you go to the symbol search. Unlike the currency pairs from TradingView, where you just click on your letters on your keyboard, but this, you have to come to this place and click here. You search for your volatility index that you want to trade with, or you go to your commodities. This derivative offers forex, stock indices, commodities, derivative or derived instruments, cryptocurrencies, and all of that. So this is volatility, and I'm clicking it and I'm going to my lower time frame to 15 minutes. So I'm going to 15 minutes and checking what the market is going to give me. Okay, this is 15 minutes, and these volatilities, they are quite more faster. Like in terms of liquidity, they have more liquidity than the currency pairs. You see, you can see that it's already moving, and this is one candle that's already moving like this on the 15-minute time frame. Whereas if you are going to the currency pairs, before you can see 15 minutes candle to move that way, you're going to take news factors or something like that before you can move rally to the upside. That's fast. So coming back to the derivative, now derivative instruments are not being affected by the news. That's one thing to note. They're not being affected by the news, so you can trade derivative or any other instrument like the volatility index and others. You can trade them without thinking about the news. The news do not affect this market. They are quite known as the simulated markets, so they are being copied from the currency pairs, so they are simulated. And trading these indexes, you can trade them weekends, like that is, you can trade them on Saturdays and Sundays because they have no stop time, so you can trade them Saturdays and Sundays. And that is why most of traders are tilting towards this derivative side, because you can see that it's already moving so fast. You see the volatility here is crazy. So why traders are tilting towards this side is because the derivative instruments, you can trade them weekends and they are not affected by the news, while these currency pairs are highly affected by the news. In fact, we have my FX book, my forex factory, that's you can use to check news that can affect these currencies, because these currencies are being used by their respective countries. So anything that happens to that country, be it war or their investors and everything, things like that, can greatly affect the currency when trading it. So moving back to our volatility. So trading this volatility, you can trade them on weekends, and traders get bored. Most traders get bored while trading currency pairs because they are not fast as this. So most traders want to just go in and out of the market. Like if they are going to lose that trade, let them lose the trade instead of waiting for like years before they can take profit or take their loss, so they can move on. You get my point? So this is derivative, and this is where you can search. You can also use tools like this, like the one on our trading view. You can just drag it for trend traders. You can drag it like this. We have our long position. You can just drag it like this, like so. Then we have our Fibonacci. Sorry, this is not Fibonacci. Alright, so we have our Fibonacci here. This is our Fibonacci. So we have tools like this here also, and you can type in anything you want. You can just type in anything you want. Alright, so that is all about volatility. So this volatility, they have their own platform where you can fund it. So you go to your derivative, you register, and you fund it. While TradingView, they have a lot of brokers, as you all know. You can also use Xness, like the one on my description. So you can just register with them for trading volatility pairs. I'm sorry, for trading currency pairs. Then go to derivative to register for your volatility, and you can trade weekends or anytime you feel like trading. Alright, so that is all about the differences between volatility and currency pairs. Alright, so like, subscribe, comment what you think below, hit the notification bell, and let's feel fly. Peace.